Hi, everyone. My name is Diane Donnelly, and I am the president of the Donnelly Group of Keller Williams Flagship of Maryland. And welcome to Facts Not Fears, where we are going to be talking about today a really cool topic, a portfolio type of loan that is dedicated to our doctors and our nurses, and Ken Gerhart with Wesbanco Bank is going to be talking to us about the program. But we came to this series because during COVID, there were lots of questions. There was tons of information. People just didn't know where to go for information. So we had gathered with a bunch of friends and some clients, and they said, you should do podcasts type things and get some people on here who know what they're doing so that there's the source for information that people can rely on. So that is what this series is all about. And today we are going to be talking with Ken, and he is going to introduce us to a program that really amazes me. And I am particularly excited about this program because of COVID, and these doctors and nurses are putting their lives on the line every single day. And now we're going to talk about a perk that is a phenomenal program. But Ken, if you would, before we begin, can you tell us about yourself? Tell us who you are and a little bit about Wesbanco Bank.
Sure. I'm Ken Gerhart. I've been in the business since 1989 when rates were 12.5%. So we've come a long ways. I currently work at Wesbanco Bank, which is a publicly held company. It's regional, and they do a phenomenal job on the mortgage side. Obviously, they have a lot of other banking services as well, like most banks, but I'm on the mortgage side. And as Diane said, we're going to be talking about the professional loan programs today. That Wesbanco has, and what they call their portfolio program. And portfolio is nothing more than bank money. It's not Wall Street money. It's Wesbanco bank money.
Okay. And Ken, who is eligible? So I've always heard of a doctor's program as doctors and nurses, but this is a great deal more than that. So who is eligible for this particular program?
Yeah, so the doctor programs originally came out probably about 15 years ago. And they're exclusively from banks because it is bank money. And they started out with, offering it just to doctors. And most of the programs out there from banks are just for doctors. That's it. Wesbanco went a little step further and made it from doctor designations all the way to lawyers and CPAs. So on the medical side, it can actually even be a medical student. So you go back and be a medical student, you can be in residency, or you can be a fellow. If you're not sure what a fellow is, obviously if somebody out there listening is one, they know what they are, but they're people that are in research, they have medical degrees, but they're either teaching at universities or they're in research. And so they count as well.
I was talking yesterday to a lady, and she's a PA. Perfectly equipped for this program, right? You'll handle PAs as well?
No, they have to have a medical doctor's designation.
Okay.
So even nurses and PAs don't qualify. I wish they did. I think they should. I mean, obviously nurses do a tremendous amount of work and we appreciate them. Unfortunately, this program is just for medical designation. I do not know of a doctor's program that includes anybody outside of the medical designation. There might be one. I'm just not familiar with it.
I think we should start one.
Okay. Well, if you got a pile of money in your bank account, I'll take a little bit out and we'll start one.
I think we should use Wesbanco's money and do it.
Yeah, we probably should. I know
they deserve it.
I know we could do loans because I get asked that all the time about the nurses and PAs and other designations that are not doctors. So
yeah,
it is specifically for that. So the nice thing about it is that the medical students, the residency, and the fellows, they can get a high loan to value, which is the difference between the sales price and the mortgage, or a down payment of 5% on their program, which is really nice. And there's no mortgage insurance, which is huge. If you do the calculation on that, the difference between paying mortgage insurance or just paying on a loan is tax deductible. Mortgage insurance is not. So that's a huge advantage. And then with the other medical designations, doctors, optometrists, you go forth and so on, then those people, they can do a 10% down loan. Okay. That has all changed since the pandemic started. These programs were 100% programs beforehand. And since the pandemic, almost every bank has reduced their risk on those loans a little bit down and had some, put some skin in the game, and have people put more down payment down. I think
risk to them, right?
Yeah, I think they're just managing it. I think it's smart because if everybody remembers 2007 and 8, before that, a lot of banks and mortgage companies weren't smart, and Wall Street wasn't smart, and it killed us. I mean, it killed the financial industry, the mortgage industry, the real estate industry, and we don't want to go back to that point.
We do not want to go back to that.
I actually appreciate it when I see executives at a bank taking a little look forward. I think this is short term as far as this goes. I think once they get a feel for the how many people are making their payments, because right now you don't have to, that I think once they get through the year, if they start seeing that these loans are performing, because we are dealing with higher income people usually, that they'll go back to higher loan to values. I think that'll happen.
Okay. What about, are they all 30-year loans? I think that there's several loan programs that are available, not just a 30-year fixed rate, fixed term.
Yeah, there's a bunch of them. You can get into all the arms, the 1-year arms, 3, 5, 7-year arm, 10-year arms. And on this program, they don't have a 30-year fixed. They have a 15-1. So it gives you 15 years of fixed on the mortgage, but it's amortized over 30 years. So you can amortize it over 30. So
okay. That's great. What are the interest rates, for example, on this loan? As
of today, it was 3.5%. Rates are a little bit higher on these mortgages. They're a little bit higher risk, and that's typical of a bank. But if you weigh the mortgage insurance and the interest rate difference, again, the interest rate's tax deductible. The mortgage insurance is not. Some people say, well, I can get rid of my mortgage insurance. Well, that's probably a big myth in the mortgage industry. The only way to get rid of mortgage insurance is to get more than 25% equity in your home and be approved by a bank. And at a time like right now, with the risk we're at right now, no one's getting rid of mortgage insurance right now and care probably if you had 30% equity.
Really? And banks reserve the right to do that, to say, you have material in your hand that says once you get to 20%, you don't have mortgage insurance or whatever the bank term is. So say it's 25, they're able to change that in the midst of a pandemic or at their
well, the material doesn't say that. The material just says when you get 20%, you can apply for it. I've never seen anybody get rid of mortgage insurance just on 20%. Now, if somebody wants to refinance and then you get an appraisal high enough, then you could get rid of it through that. But just going to the same bank or same mortgage company, you're probably gonna need 25 to 30% equity to even get considered. Okay. And that's if you've made every mortgage payment and your credit's still good. Okay. So there are some variables in there.
And speaking of credit, what is the credit score for somebody to be eligible for this program?
Right. So for the medical students, the residents, and the fellows, it's 680. And for all the medical designations, the lawyers and the CPAs, it's 720. So these are high-end loans. They're looking for, the high-end people who make good money, may pay their bills. They're not for people that don't pay their bills and have, lower than credit scores than what I just said. There's no exception.
And what's the reason that there's a difference in credit score between the industries?
Well, mostly because when you come out of medical school, you're going to have probably more debt. And so your credit score is going to be reflective of that. And so your credit score is probably not going to be as high as someone who's been practicing for 5 or 10 years, who's been paying on debt and has that history. Okay. So you've got a shorter period history. Okay. So that's the reason.
And I want to underscore what you said earlier about the student loans, right? Student loans are not included in this. A portion of that debt is, correct?
Yeah. So the way they're doing this student loan now, which is a change recently, I think I talked to you about it earlier this week. Before, they didn't count any student loan. And now they're going about whatever's on the credit report. But a lot of times what happens is your paperwork might say, oh, you owe $900 a month. But when they report it to the credit bureau, say you owe $50,000, a lot of times it's only 1% of the loan amount. So it would only be $500. So whatever's on the credit report is what we count. So if it says $12, we count 12, so whatever's on there.
And what are the ratios for the program?
The back ratio is 36%. However, that can be expanded. You have good credit scores, good assets, all the other good parts of a loan. Then you can expand that, probably up to 41, 42, maybe even 43.
Okay, and if you would describe what a back ratio is for the folks that aren't in the industry and don't know what ratios are.
Yeah, so that's when you take all of your income and you put it up against your debt and your housing payment. So a front ratio is just your income and the percentage of housing payment that you're using. The back ratio is your income, and then you take all your debt and your housing payment and what percentage of your income that is. So if you make,
when you say that, it's what your minimum payment is on your debt.
yes, it's the minimum payment, not what you're paying or what you decide to pay. It's whatever's on that credit report.
Right.
So a lot of times, like
utilities, no, we're not talking about utilities.
no
Just
utilities,
revolving in installment debt.
no cell phones. Yeah, exactly, revolving in installment debt. No BG&E bills or cell phone bills or anything like that, or insurance bills or anything.
Okay.
Just straight, credit card debt, housing debt, things like that, car payments,
okay,
boat payments, things like that. Yep.
What is the minimum loan amount or maximum loan amount if you have them?
There's no minimum. The maximum for the first group, the medical students, the residency, and the fellows, is $500,000. They can be expanded a little bit, just depending on what the situation is. Probably wouldn't go over 600. Might go to 550, 575 in some cases, but you have a really strong loan. For the medical designation, lawyers and CPAs, it's it's $1 million. And again, that can be expanded. We just have to submit that to the bank, and they look at the loan. If it's a really strong loan, they'll expand it. I was told that the highest anyone's seen one go is about 1.6 million. But those are really, really good loans. Strong credit, strong income, all the components, lots of assets, lots of bank assets, things like that.
And what about loan types? So for dwelling types, is it primary property only, or do you do rental properties, investment properties?
No investment properties at all. In fact, right now the mortgage industry is very difficult on more investment properties. In fact, there's probably a handful of people even doing them right now. Mm-hmm. And my guess is it's a large down payment. So it's probably pretty tough. We're not doing any investment properties on any of our product right now.
Yeah.
Because the bottom line is you don't have to make the payments. So that's the highest risk of the group anyway. But other than that, all the other properties are eligible, even second homes, primary homes. You can do condos, townhouses, single family. So you can do all that. Yep.
Okay. Ken, what am I not asking that a buyer should know about?
Oh, that's a good question. Let's see. I mean, really, you've covered it for the most part. I mean, it's the type of loan for specific occupations. That's the way to look at it. They've been around for a while. I think the cool thing is that you can expand that into the attorneys and CPAs. The CPAs have to own their own firm. An attorney does not have to be practicing. They just have to be licensed. So a lot of attorneys, when they retire, maintain their licenses. So that would be okay. They can't be an attorney that a license expired. So all these categories have to submit a valid license on the medical side, the attorney side, and on the CPA side. You have to have a valid license that you're doing business.
Okay. Is that the only difference? Is that the only document that you would need that's different from any other program? So you need W-2s, pay stubs, bank statements, tax returns, and the certificate or license. Is that basically it? Same as the other programs?
Yeah, pretty much. Yep.
Okay.
Because it's all done the same. It's just once you've got into the category that you fit into the program with whatever designation you have, then it's just a regular loan after that with a lower down payment and no mortgage insurance. That's the big key, is that no mortgage insurance.
Well, it's no mortgage insurance with a very small down payment.
Correct. Yep.
Yeah, that's really good.
Yep.
What is the time period? How long does it take you to process one of these?
So it's really cool. We were on a phone call this morning with our entire operations staff this morning, and it was amazing. I mean, I've been doing this for a long time. I worked at MVR just like you did, and we had operations and everything we used to track, and we used to get really excited when we get something through underwriting in 7 or 8 days.
Mhm.
That was exciting.
That
Um,
was.
yeah, yeah, 7 or 8 days was exciting. They're actually averaging right now for the last 90 days, which is amazing, 2.1 days in underwriting.
Oh my gosh.
And the volume is up, it's not down. So I was really, really amazed with that. And I was like, those people that work the back rooms don't really get, there's not a lot of visibility of those people. The setup people, the processors, the underwriters, the closers. I mean, that whole group back there, they kind of work in silence because they don't get to meet the customer in a lot of cases. They can't, not even allowed to talk to customers because customers could influence them, and all that. So it's 2.1 days. So, and to get it into underwriting, I actually took a loan on Wednesday and we actually put it in underwriting today. We got everything approved today. So all we got to wait for is an appraisal and we're good to go. It got approved. All the disclosures went out today. So we did that in 48 hours. We did the whole thing in 48 hours.
You're located in Severna Park. You yourself are located in Severna Park. The company is.
So our office is down on Riva Road,
Mm-hmm.
where the Annapolis office is. And then we have our regional office is in Bowie. And then the headquarters is out in West Virginia, the Wesbanco.
And where is your underwriting? Where's your department for underwriting?
Oh, they're all at home now too.
All different places then.
Yeah. We actually have some in our office in Annapolis.
Wow.
They're in Bowie and they're also in West Virginia as well. So you just you get assigned a team of underwriters, and then if their volume goes up and down, they can pull other people into that team if someone's volume is not as high, because underwriters know the guidelines, whether it's in Ohio or Virginia or Maryland, it's pretty much the same guidelines. There's not much difference.
So two things there. I love that it's you can take a file and say, hey, underwriter, here's the deal. Here's why this makes sense. Can I run something by you? And you can get an answer basically right away, right?
Oh yeah. Oh yeah. You can do
That's
pre-qual.
wonderful. So people that don't know this portion of it, that's amazing that you can do that. That's a huge plus.
Yeah.
The other thing I was going to say, there's two things. Oh, where do you lend? Where are you, or is this program eligible?
So it's eligible in 9, I guess, states, including the District of Columbia. So you got Virginia, District of Columbia, you got Maryland, Delaware, Pennsylvania, Kentucky, Indiana, Ohio, West Virginia. I think that's 9.
I think that was 13.
I think you were doing.
Sounded like a lot of them.
Yeah, and we lend in other states with our other products as well. Quite a few: California, Texas. I mean, I could go through all of them, but I think it's 38 total states we can lend the regular product, FHA, VA, conventional loans. But on these particular products, where it's bank money, it's not Wall Street money. The bank, they can only by law offer these products wherever they have a branch. So they have a bank branch. So that's the law across the country. Okay. So that's where they have branches right now, and so that's where they can lend.
You know, one thing that we're starting to see on the real estate side is VOEs, verification. Oh my God, I can't think of the word.
I'm refusing.
Verification of employment. Right. I shouldn't have had that extra glass of water. Yeah, but they're getting delayed big time because people aren't in their offices, the corporate office is closed, et cetera. So we're having a lot of delays. Are you seeing that?
No. And I'll tell you why. To go back to how things get underwritten today so quickly too, the old world was you got a loan, you walk down to your processor, they processed all the paper they got from the borrower and they gave it to an underwriter and they sent it up there in a package or in a fax or whatever. In today's world, we take all of our apps online just about. I send an email out to the customer. It's got a little green button at the bottom. It says apply with Ken. They click onto that. They fill it out the best they can, and then they send it. And it comes to me, and then we fix it from there. And then from right there, once we fix it, we send it right into what they call desktop underwriting. It's all automated into Fannie, Freddie, or into the bank for the portfolio loans that we're talking about, and they get underwritten electronically. So no person even touches it at that point. If it meets all the criteria, it just gets approved, and you're kind of done.
So you may not even need a VOE.
Well, in some cases, you're going to need a VOE, but it's all automated today. So our whole system's automated. We have a software package that actually you put the name of the company in there. It actually loads right to the company. The company loads the verification up, and it comes right back. It's basically done in the same day.
Wow.
There's not a person. It's not like typically a person involved. I'm not sending it out in an envelope to a person sitting at a desk who's on vacation, or, down in Hilton Head or something.
Right.
It's an automated system. Now, not all companies are on that system. So what you're probably seeing is when you get to a smaller company, and yes, you do probably have to send it to them. And then it's just really a matter of the loan officer, in my opinion, making sure that they have the right person, or the customer has the right person that they have to send it to. And then it gets done.
Yeah.
So
I think I have to talk to a loan officer today. We're having a delay.
Well, and there may be a good reason for the delay. I don't know. I mean, everything. That's the thing about mortgage banking in your industry. Every deal's got its own thumbprint, own fingerprint. There's no two deals alike. I've been doing this since 1989. Never seen two deals exactly alike.
Yeah.
They all have something different. So,
and there's different rules being made now with COVID and different restrictions that are on there. And because it's been so busy, and because of these VOEs being very difficult to get in some cases, we have to be flexible, but we have to set the right expectations with our buyers and sellers to say, we're going to be really strict. We're going to stay on task, but be prepared and to be able to pivot if there is a delay. Don't put your schedule so tight that an hour late is going to really disrupt your life. So we're trying to have conversations about that too.
Yeah.
Are there any questions? I'm sorry, Ken.
That's a great question to ask all the time. Absolutely.
Yeah, I agree.
The other thing's happening for refis, because the refi is really happening right now. It's big. Our company, and I think this is the right decision, they're prioritizing purchase deals over refis, because the person's already in the house, you're just lowering their payment. So we're making all of our refis lock in for 60 days. Even if I could get them approved in 2 days and take them to settlement in 10 days, we're not doing that. So we're taking all the purchase deals, we're prioritizing those and saying, hey, these have to settle on a particular date, because you have a transaction involved, and you have people selling a house, moving out. And so there's more to it, more pieces to the puzzle. So we explain that to our refi customer, just so they don't say, why can't I close next week? Well, because, we have this many purchase deals to close, and we'll get them closed. We're going to get all the refis closed, but that's what we're doing.
Right.
I think it's a smart thing.
Yeah. That makes
Because
sense.
we love the purchase business. That's the steady Eddie business, is the purchase business. The refi business kind of roller coasters. If the rates go up, that kind of gets cut off in a hurry. If it goes up 0.5%, you lose 50% of your refi people that quickly. Yep.
Yeah. Overnight, like that.
Overnight. Yep. If they're not locked in, they're gone.
Yep. Okay. Kayla, do we have any questions in the queue?
We do not at this time.
Okay. Thank you. So nice. Ken, if somebody wanted to reach you about this program, how do you prefer to be reached?
Well, I mean, my cell phone is great. 410-493-5648. And then they could also email me at ken.gerhart, Gerhart, at wesbanco.com. They could also go to the Wesbanco website, and they can just go up in their loan officers, find my name, Ken Gerhart, and they can pull down right from there and access me there as well.
Okay. Ken,
or they could go boating or they could go to the golf course this afternoon, and I
think that's the best plan.
Yeah, I can go to Compass Point, and I'll be teeing off around 5:30 today.
I'm not sure. I'm looking outside. I'm not sure you're going to be doing that, Ken.
Well, I'm planning on it. That's
all right.
Just say it's Friday. So that's my happy hour.
Well, I appreciate you, Ken, coming out and talking to us, and especially I love this program for the reason I talked about before, is that these guys, the doctors, are out there making things happen, and maybe one day we'll get these nurses programs together too.
I agree. I'm surprised they're not on there, to be honest with you. I'll talk to the people that make that happen, see why we can't add some of those people.
Thank you. I
That'd
would
be great.
appreciate that.
Okay.
And for the listeners, thank you for listening. We appreciate it. If you know somebody that fits this bill, please pass this on to them and make sure that they're able to take advantage of something that they very much deserve, and share it on your wall. We appreciate that. And everybody have a great weekend. Thanks for tuning in, and we will talk to you soon.
Thank you.
Bye,
Appreciate
Ken.
it. Have a great weekend.
You too.
All right.
Bye-bye.
Bye-bye.